Welcome to our training on PIPE investing. This is a topic that is often brought up when discussing private equity and its different kinds of investing. This video will help you to understand what a PIPE is and how investing in one can be done. PIPE is an acronym for Private Investment in Private Equity. A PIPE investment involves selling publicly traded common shares or forms of preferred stock and convertible security to a private investor at a discount to current market value for the purpose of raising capital. These PIPE deals can either be registered with the SEC or completed as an unregistered private placement. The attractiveness of PIPE transactions has waxed and waned since the late 1990s. For private equity investors, PIPEs tend to become increasingly attractive in markets where control investments are harder to execute. Generally, companies are forced to pursue PIPEs when capital markets are unwilling to provide financing and traditional equity market alternatives do not exist for that particular issuer. In recent years, top Wall Street investment banks have become increasingly involved in the PIPE market as placement agents. Through the acceleration of the credit crisis in September of 2008, PIPE transactions provided quick access to capital at a reasonable transaction cost for companies that might otherwise have been unable to access the public equity markets. Recently, many hedge funds have turned away from investing into restricted, illiquid investments. Some investors, including Warren Buffett, found PIPEs attractive because they could purchase shares or equity-linked securities at a discount to the public market price and because it provided an investor the opportunity to acquire a sizable position at a fixed or variable price, rather than pushing the price of a stock higher through its own open market purchases. Existing investors tend to have mixed reactions to PIPE offerings, as a PIPE is often highly dilutive and destructive to the existing shareholder base. Depending upon the toxic terms of the transaction, a PIPE may dilute existing shareholders' equity ownership, particularly if the seller has agreed to provide the investors with downside protections against market price declines, a death spiral, which can lead to issuance of more shares to the PIPE investors for no more money. The SEC has pursued certain PIPE investments, primarily involving hedge funds, as violating U.S. federal securities laws. The controversy has largely involved hedge funds that use PIPE securities to cover shares that the fund shorted in anticipation of the PIPE offering. In these instances, the SEC has shown that the fund knew about the upcoming offering in which it would be involved in prior to shorting shares. There are two main types of PIPEs: traditional PIPEs and structured PIPEs. A traditional PIPE is when common or preferred stock is issued at a discount to raise capital. A structured PIPE is one where convertible securities are issued to investors to raise capital. Either kind of PIPE is great for small to medium-sized companies to raise capital, because PIPEs lower the cost and shorten the time necessary to raise capital, and these companies often will have a difficult time raising capital through traditional channels. Many reverse mergers are accompanied by simultaneous PIPE transactions, which is typically undertaken by smaller public companies. Shares are sold at a slight discount to the public market price, and the company typically agrees to use its best efforts to register the resale of those same securities for the benefit of the purchaser. One thing to be noted regarding PIPEs is that they often have less regulation. The regulatory environment in certain countries, including the US, Australia, Canada, and the United Kingdom, are accommodating for PIPE transactions. However, in certain areas, there are stated preferences for rights issues, which allow existing shareholders an opportunity to invest before the company seeks outside capital. In these jurisdictions, once a company has completed a rights offering, it may pursue a PIPE transaction. Though legal regulations are accommodating to PIPE transactions, it is widely perceived that such transactions are an option of last resort for failing firms and as means of which unscrupulous investors may profit at the expense of common stockholders. The existing investors in the company are often against PIPEs as well because the process will dilute their shares' value. This dilution of share value is more evident when the seller includes a provision to issue more shares to the investors if the price declines to prevent what is known as a toxic PIPE. With private investment in public entity from a venture capitalist, the investor is typically looking for a minimum return on investment of at least 30%. A venture capitalist will give money to a company that a regular bank would not, as they will take the risks. Their risks are only if there is a potential for high returns. In summary, private investment in public entity investments do the following. 1. Apply lower and more realistic valuations to early-stage companies. 2. Supply the funds that the public entity needs. And 3. Use the public markets as the investment exit vehicle. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.